Hey everyone, I just got a great question on TikTok that I'm going to come over here and answer instead. And the question was, how do you trade in a bear market or a recession, depression, economic disaster, pullback, correction, dip, whatever? How do you trade in those kinds of markets? We get how you trade in a bull market because everything's going up. It's easy. You just buy something and it goes up, you sell, you take your profits. Congratulations. But how do you do that? And how would you as a trader trade in a recession or bear market? This is a good question. I have to preface by saying this isn't a one-size-fits-all kind of answer because every recession, every correction, every dip is going to be different and it's going to be driven by a different thing. So with that being said, this isn't how to trade in any recession. This is just some tips, some things that you might be able to apply based on whatever the recession is down the road. First thing you got to remember is all recessions are different. Second thing you have to remember is that you will probably, second thing you'll notice, first thing, all recessions are different. Second thing, you'll probably be trading a little bit less. That's just the reality, right? Because as a swing trader or day trader in a bull market like what we have currently, I'm able to look at a stock that's selling off because of bad news or just a down day or profit taking or whatever, and I'm able to look at the relative strength index and go, oh, this stock is oversold. I'm going to get in here for a bounce play or a quick scalp, or maybe there's a bit of news and the stock is really hot and everyone's piling in. I'm gonna go for a scalp trade. I'm just gonna buy it here and sell it a little bit higher here, take my profit and get the hell out. Those bounce plays and scalps tend to work a little bit less well in bear markets because the bad news just keeps piling on. So on days in bull markets where we have a correction or a pullback or some profit taking, what you might see is the market is down 90 points, 100 points, 300 points, and then it starts to recover. In a bear market, what you see is the market is down 200 points, 400 points, 600 points, 800 points. And so the technical analysis doesn't really work because it's news driven and it's panic driven and it's fear driven and it's hedge funds dumping their shares to take their profits. And so it's just more and more bad news. So your technical analysis doesn't really do you any good because it doesn't really work as well in a bear market. So you're going to be making fewer trades. That's number two. Number three, I would be buying puts and I would be shorting stocks. Reason is, if this is a really bad situation that we're dealing with here and this news is going to be prolonged agony for a while, I'm talking about weeks to months or longer, these companies will start having bad earnings. Bad earnings will make those companies make hard decisions. We got to lay off some people. In a bull market, laying off people is often seen as a good thing because it's, hey, look, this company's able to have fewer employees and still do the same high quality job that they've always been doing. And yes, it sucks that those people got fired, but they'll find work elsewhere because it's a thriving economy. In a bear market or in a recession, when they start laying off people, it's a sign of trouble. They can't afford to pay these people. It's not a productivity thing. Hey, look, they're able to downsize but still be productive. It's, they don't have the money to pay these people. And every company is laying people off. So where are these people going to find jobs? It's not necessarily about saving money, although these companies will be saving money because they're firing their staff. But it's a ripple effect because everyone's firing, nobody's hiring, and all these people are going to end up on unemployment, which just it's like a spiral effect. It makes everything worse and worse and worse. And the more companies that lay off, more companies lay off because less people are spending. So more businesses are being impacted, and it's just this ripple domino effect of misery and awfulness. And so I would be shorting and I would be buying puts. I don't trade options a lot. In recessions, you kind of it's an option, right? Either shorting or buying puts or both. It's an option because the markets aren't going to be going up. They're going to be going down. And that's why I always talk about how it's important to have multiple strategies here as a trader. You're going to see a lot of these new traders coming out right now, as I have been, saying, oh, I'm a trader now. Oh, cool. How long have you been trading? 3 weeks. You gotta have more than one method because markets change frequently and you have to be prepared. You know, what works in one market might not work in another market. What might work in one economic boom might not work in another economic boom. What are you going to do if there's a sell-off? What are you going to do if there's a recession? How are you going to trade? If you only have one method to trade with, you're in big trouble. That's why in bear markets, I buy puts, I short stocks. In bull markets, I swing trade. I go much more long term because I'm riding that momentum. In choppy markets like what we've had the last couple of years, I day trade. You gotta have different strategies and you gotta find what works for you. I know some traders right now who are still swing trading through all this volatility. They don't mind it. They are good at it. I prefer not to. I prefer to day trade and make quick trades in and out, take my profit and move on. That's just my method. Everyone is allowed to have their own. Everyone's allowed to have what works for them. That's why I encourage you to try a variety of things, learn a bunch of different things, and have a plan for every kind of market because you're going to need one. So in a recession, in a pullback, in a dip, in a depression, I'm shorting, I'm buying puts. I'm not trading as frequently. You might have heard expressions like dead cat bounces or catching falling knives. They don't have pretty names because they're not pretty. They're very risky. In bull markets, they tend to work a little bit better at least. In bear markets, like I said earlier, they don't work because the technical analysis isn't on your side. It's panic and it's fear driven and it's news driven. These stocks will just keep dropping all day. So when you're trying to catch a falling knife up here, that shit's gonna drop way lower. Or a dead cat bounce might not be a dead cat bounce, right? The cat just might be dead. And you might be thinking, oh, I'm gonna buy here for a little bounce, but there is no bounce. The next thing I would say to do, or at least what I would personally be doing, is I got my notes over here. I would be paying attention to the news because there will be glimmers of hope. There will be positive news that comes out. Some companies will do okay during these bad times. So even though you're trading less, it doesn't necessarily mean that you're not trading at all. You just need to keep an ear and your eyes on the news, paying attention, reading, looking for opportunities, and seeing what's working for stocks, maybe even to trade, because there will be things that do okay, and there will be bounces, and there will be little teeny rallies here and there when a little bit of news comes out that's positive. Hey, this company was going to fire 25% of their workforce. Oh no, but they only fired 15%. You know, people are going to look for any little bit of good news to say it's a positive, and the markets will rally. So there will be opportunities potentially for swing trade or for a bounce plays or scalps or quick day trades. I wouldn't be swing trading in a bear market. I would be looking at it as, hey, this is a lucky day for me. I'm gonna make a quick trade. I wouldn't be swing trading because swing trading, you hold for weeks potentially. I'm not holding for weeks, not in a bear market, not in a recession, not in a correction. No way, buddy. So I'm taking my profits when I got them on any good news that we have. How many trades are you going to be making? Maybe you're going to be making half what you would make in a bull market. Maybe you're making a quarter. I don't know. That's why it's so important to have an ample rainy day fund, because there's no money for you. You're not generating as much money unless you're crushing it shorting stocks or buying puts. And by the way, most people don't do that because most people get nervous in these bear markets, in recessions and dips and corrections. They get a little nervous and they go, I don't want to do anything with my money. I'm just scared. I want to have my money. And that's why it's okay to have an ample rainy day fund that you live off of during a recession, because you don't have to be making trades, right? Unless you need the money. It's okay to step back and go, these markets are making me too nervous. Boy, am I glad that I have my rainy day fund over here that'll last me 6 months or maybe even longer if I have to really stretch out and and maybe like eat ramen for a while. You're going to be glad that you have that and not a closet or a house full of crap, because what are you going to do with all your stuff? You can't even sell it on eBay because in this hypothetical scenario, everyone's laid off, everyone's been fired, no one has money, nobody's buying tchotchkes, nobody's buying old video games, nobody's buying old shoes, nobody's buying anything because they're hoarding their money, they're scared. That's why it's important to have your ample rainy day, live below your means, not try to buy a bunch of stuff to impress people or fill a void because you're depressed. You're going to be thankful when that economic ruin comes and everyone's laid off and everyone's fired and everyone's going, I can't believe I bought all this crap and I have no money. And you're going to be the one sitting there going, hey, instead of buying 100 things of crap, I bought 15 because I live below my means and they were the things that I really liked, and all that extra money that I didn't piss away on garbage is now sitting in a bank account. And I know people say, oh, you shouldn't put money in the bank account, but you should have your rainy day fund. You don't want your rainy day fund to be comprised of your investments necessarily, because if the markets dump, then you're losing money, or you're having to withdraw from your investments, which you only should really be doing if you're desperate for money or you need that money. I love selling off some stock to buy something, right? I love using my stock to pay for it, something, so I don't have to use my savings to do it. In a recession, though, I don't you might be selling for a loss on some of these investments just to recoup some funds, which is fine. If that's what you got to do, that's what you got to do. So you're going to be glad and grateful that you've lived below your means. So even though the person on TikTok who asked me and said, other than living below your means, how would you trade and function in a bear market? I still got to mention it. You still got to live below your means. It's very important to not piss away your money in good times, because bad times are always just around the corner. And you will be grateful that you have money in savings, even if it's not earning as much in interest. You will be grateful that it's there. And the next thing is why it is important in all markets to be investing in dividend-paying stocks. And I know people say, oh, dividends are over, it's all about growth stocks. In bull markets, sure, of course, growth stocks are amazing in bull markets, right? Stuff is up 400%, 1,000%, whatever. And you look at like Verizon with their 4 or 5% dividend and you go, psh. But growth stocks work great in bull markets, but in bear markets, they don't really work so well because, like let's look at like Tesla, for example. If we are in a state of like complete ruin, right? Economic collapse that goes on for months, if not longer, nobody's buying those luxury cars. Nobody's buying Teslas. So the luxury brands take a beating. Retail takes a beating. Housing takes a beating in depending on what's going on with the individual recession. There are so many there's travel, airlines, hotels, casinos. There are so many sectors that get crushed. Luxury goods especially get crushed in recessions because nobody's buying anything. So growth stocks don't work as well. It's why it's important to be diversified. I always say that people go, if you had to choose between growth stocks or dividends, which would you choose? I would choose both. I would choose growth stocks in a bull market and dividends in a bear market. But if you're getting in the bear market, it's a little too little too late. You want to be doing it all the time because you don't know when the recession is going to come. It could be tomorrow and it could be a year or it could be 4 years from now. You want to be doing both. You want to be building on your growth stocks and then taking profits along the way, locking in your gains and buying back on bad news or dips or whatever, like this. But you also want to be steadily adding to your dividend stocks as well. Reason being, when a bear market or a recession comes, you're going to be like, oh, I'm still going to be making money off my dividends. Now, maybe some companies might cut their dividends, but others, they're called like evergreen stocks that do well in all kinds of markets. They usually don't cut their dividends. In fact, they might even increase their dividends because they want more people coming into their stock, buying their stock. So they might increase dividends. You don't want to be in companies that pay dividends, but their earnings aren't so great, because they're going to be the first to go, we're cutting, like Ford. When the automotive and the housing and all that stuff started to crash in 2008, Ford used to pay a hell of a dividend, 60 cents a share. And I think it was, I can't remember what the price of the stock was, but it was an ample dividend. 60 cents per share got you a long way back then. And then they cut it. Ooh, and that brought the stock down even lower. Oh, that sucked, because I had a lot of Ford stock. Still do. But the companies like Johnson & Johnson, Procter & Gamble, General Mills, these good, like forever companies, that's why they're called evergreen, right? Because of the evergreen trees, they never go away, they're always there, you know? I guess they're called evergreen because like the leaves fall off regular trees, but they don't fall off. Anyway, who cares? The point is, you want your dividend stocks now. You want to be building to these positions. So you have 100 shares, and then you have 300 shares, and you have 500 shares, and then maybe you have 1,000 shares over a long period of time. That way, when a recession comes and you're a trader and you're not making as many trades because you're nervous or you're hoarding cash or you're using that money to buy your investments, you're still getting some income through your dividend stocks. That's why it's very important to do both. The last thing I'll say, because I'm running on a little here, is in recessions, there are still stocks that do well. There are still companies that do well. Think about it. It's a recession, so you're not buying luxury goods, you're not buying gadgets, you're not buying fancy cars. What are you still buying, right? You're still buying food. So the food stocks, not the grocery store stocks, they're usually lousy investments. The food stocks, the people who make the food, the General Mills or Heinz used to be publicly traded. I don't think they are anymore. Alcohol stocks do very well in recessions because people are depressed, so they tend to drink a little bit more. Alcohol. I'm rambling here, so I'm getting a little off message. You got to find the stocks that do well. In any recession, there will be stocks and companies. Who the hell keeps calling me? I hate this number. I'm just going to block them. They call me twice a day. So annoying. Spam. The last thing I'll say is you have to keep your ears and eyes open for the stocks that do well in recessions. There are always going to be companies that do well in recessions. Maybe not as well as they did in bull markets, but still, like Evergreen, there are companies that you're going to continue to use. Now, it might not be like gas stations. If you don't have a job and you're not driving anywhere, it might not be gas stations, but you still got to eat, right? So people who have families, they're still buying groceries. So the companies who make the food, right? Who make General Mills, for example. They make cereal, dried goods, boxed foods, canned goods, and stuff like that. Alcohol. People are depressed in bear markets or in economic downturn. I shouldn't say bear markets. Just in recessions, people are depressed. They tend to drink a little bit more. So alcohol stocks tend to do well. You have to keep your ears and eyes open, paying attention to what is working in that particular market. And like I said at the beginning, all recessions are different. So it might not be the same every single time, but that's why you have to keep your ears and eyes open. So to summarize, trading is going to take a hit in a bear market. You're going to be doing a lot less trading, which is why it's important to have ample money in savings. You also might be doing some shorts or buying some puts. You might be paying attention to the news for bounce plays, but you'll be making significantly fewer trades because of the increased level of risk. You'll be adding to investments. Add, scaling in gradually. You don't know when the end is going to be, all right, on your investments. You don't know. Maybe you buy, maybe you're buying in blocks of 100 at a time, 100 at a time, 100 at a time. You're going to run out of money very quickly. What if you bought in blocks of 25 at a time? You're not going to always time the bottom. You don't know where the bottom is going to be. You might think, oh, the stock is going to go lower, and so I'm only going to buy a little bit here, and then hey, the recession's over and everything's great, and you go, oh man, but at least you started buying. What is this on my phone? At least you started buying a little bit. That's better than dumping all of your money in at the very beginning of the recession and then finding out that the recession is going to go on for months and months and months, and you bought up here, but now your stock is down here, and you don't have any money down here because you spent it all up here. That's why I like scaling in small amounts, in little teeny increments, 25 at a time, depending on the price of the stock. 25 at a time, or maybe 5 at a time, or maybe 1 at a time if it's a very expensive company. That way you have your reserves, you're not pissing away all your money up here, and it's dropping all the way down here. And maybe, by the way, you run out of money in the middle. Okay, you didn't know. Nobody knew that it was going to keep going lower. The idea, though, is to scale in slowly, adding to your quality investments, because you got to look at it like it's a sale. These recessions can be debilitating for people. That's why it's important to have money, have your rainy day, have your ample funds set over here, and be able to live off of your savings, be able to trade a little bit less, and be able to live off your dividends. So those are the two questions that I got from TikTok. I answered one in a previous video. So anyway, if you thought this video was helpful, if you liked what I had to say, please hit the bell, please hit the notification, subscribe to the channel, all that stuff. And thanks for watching, and have a good day.